All right, can you guys see this? Welcome.
Yeah, we can.
Okay, no, I'm gonna go here. All right, cool. So now, so here is the topic today. All right, so real quick, we're gonna review of what we talked about. Okay, so this is kind of types of property. Types of property. Okay, remember what are the types of property that we talked about? Okay, we talked about one single family home, right?
Sir.
Yeah.
I left my notebook at my other house. Is it okay if I write all these on a separate sheet of paper and then transfer it to my notebook whenever I get that back?
Yep, that's cool.
Alright, cool.
Okay, so we have single family home, right? We also have the multi-unit. And I know in the beginning, a lot of you guys were like, oh, multi-unit is like apartments because there's a lot of, units. No, what it's considered a multi-unit is basically, remember, duplex. What's the one after duplex? Triplex and fourplex. Okay, so I'll let you guys write that real quick, and I'm gonna pause the video. Okay, just real quick because I know some of you guys might take a little time. All right, so as you guys mentioned, duplex is 2 houses in one lot. Triplex is 3 houses in one lot. Fourplex is 4 houses in one lot. Okay, now after we talked about that, we talked about what? Apartments. Okay, even though those are multi-units, right? It's apartments is apartments. Okay. Um, After apartments, we discussed what? Condos. We discussed condos, and then we also discussed townhomes, and we also discussed commercial property. Okay, commercial property. Commercial property is what? Remember, commercial is like stores, right? Stores, businesses, and also 5 units. 5 units, and I'm not sure actually. Like it might be 5 to like 8 units, but 5 units or more. Those are called commercial property. 5 units or more in a lot. So five in a lot. Okay. So those are called a commercial property. And the last thing we did, you guys remember, was what? The empty lot, right? The lot and the land. Lots and land. So go ahead and write that real quick. So the next thing we talked about is like how much money is needed to buy property. I mean, you need money, right, to buy property, but you need enough money to what? To number one, you need money to for the down payment. Okay. Plus what? You guys remember? You need money like now. You need money to for what? Down payment and you guys remember anything?
Closing costs?
Yes, the closing costs, which are little fees. Okay, closing costs. That's what you need. You need money if you want. I mean, obviously, you're gonna end up buying the house. That's the balance at the end, but you don't need that right now. You need at least you need to make a down payment, and you also need to pay the closing costs. All right, go ahead and write that. All right. So we talked about that, where you need a down payment and you need to cover the closing costs. So you need that in your bank account, right? Um, and except for the FHA, remember that FHA, family and friends could, you know, give you money, all right, to cover the down payment, right? So how does a person qualify to buy a property? How do you qualify? You got the money, but how do you qualify? You have to have what?
A good credit score.
Right. Good FICO score, FICO or credit score. Okay. And then B, what else? You guys remember? Your debt to income. Oops, sorry. Your
You're
debt.
recording this, right, sir?
What?
You're recording this?
Yeah, why?
Because I got here late and I just.
Oh, yeah. Debt to income has to be low. The debt to income percentage or ratio, okay, has to be low. Okay, it has to be low, meaning that if your income is from what you buy, what you buy, your income is the money you make, all right, and your debt is what you owe. So you don't want to, you don't want to show them or have them calculate, not show them. You don't want them to have to calculate that all your income is paying bills. That's why it needs to be low, all right? You don't want all your income, at least you don't want 50% of, if you make $100, you don't want $50 of it going to bills. You want at least $20, right? 20%, not 50, not 60, not 80. Because why? Because they don't think you're gonna pay, you know? So how do you pay your balance? Now here's a word that I didn't throw at you. The balance. Anytime you talk about balance, it's known as the principal. So if you pay a balance of $20, you owe 80, right? That's your principal. The next month you pay 10. So 80 take away 10 is 70. That's your principal. Hey, what's your principal? So basically it's what's your balance as of now? Okay? What's your balance? All right? So that's remember that, okay? That's your principal. Okay? So there are two types of loan to pay your balance, your principal. You guys remember those? One starts with the C, and there's a conventional, and then there's a FHA. Okay? There's an FHA. All right, and there's other programs for veterans and so forth, but we're not going to talk about that. I mean, they'll usually tell you, but what's conventional? Okay? What's the difference? The difference in conventional is the amount, your down payment. So here's your down payment in the middle. Okay, so yes, Carlos, it is 20%. However, it's up to 20%. So it has to be.
Let me rephrase it. You mean a range from 20%. 20%.
So it could be from 18, 17, but again, it depends on the lender. Okay, sometimes they'll be strict and say, "No, we want 20%." That, but I have 18%. So it depends on the lender as well. Okay, and then what about FHA? Wait, what does that stand for? Do you guys remember what that stands for? Something administration. You guys remember? Federal what? What's the H? All right, I'll just give it to you. Federal Housing Admin, which is the administration, right? And how much down payment can you give on that? Anybody? Jay, do you remember that? Huh?
Oh, sir. Hey, sir, I know. Oh, how's it going?
All right, Andrew.
Wait, Fernando, did you answer or watch it?
What was it? What was it? The one thing that I didn't tell you about this FHA is the fact that there's in addition to paying a low a low down payment, they also give you what's called the PMI. Okay, so this is I didn't talk about this. PMI is added. Anything added? Added, so put added. So what's added? It's called the PMI. Okay, just why? Because they give you a low percentage, right? You got to qualify, but then you have to pay what's called the PMI. On top of that, the interest that you pay, you got to pay what's called the, you know, called the private mortgage insurance. Okay, private mortgage insurance. So what is that? Basically, that's just extra fee. So this is an extra fee. Not even a fee, an extra charge. Why do you think they put that? Well, because of the fact that it's a low down payment, right? And for them, it's just extra money. All right, we'll let you get in the house for 3.5, and the FHA will back us up. They won't back you up if you you default from payment, but they'll back the lender up. But you know what? We're going to charge you on the PMI, right? PMI. So that's like maybe $200-300 every month just for them. Bam, here you go. All right. So that's not good. So you don't want, but you know what? It's a low down payment, and eventually, and I'm going to talk to you guys how to get out of this, right? How to get out of this. So again, on the conventional, there's no PMI. And why? Because you paid a good percentage, right? Where over here, 3.5, okay, you're paying a little bit, but I don't know. I mean, yeah, you have good credit, but you know what? I got to cover my end, because you still owe me a lot of money, right? And that's why they charge the PMI. Oh, my stomach is growling. You guys hear it? Oh, recording. The only new thing that I'm telling you guys right now is this part right here, the PMI, okay? The FHA has PMI. So now the next part is how are the terms paid? I'm trying to figure out a good way to write this. So number of years, which is called the number of terms. How long is the term? So you have different types. Okay, so here for both of them, so we'll just put like this. Okay, you have what's called a 15-year term. Okay, you could pay off your balance, your principal, in what's called 20-year term. So they vary. Usually it's 15 and 30. You might see commercials 15 year, 30 years, 20. That's not there. So then the next one is a 30-year term. Okay, so you could pay your loan off, your principal, right? Because how do you pay your balance? All right. So then the number of years, it could be 15 years, it could be 20 years, and it could be 30 years. Okay. So then here also, there's two types of rates. Okay. So types, oops, types of interest rates. Okay. So this is for both. All right. So there's what's called the fixed rate, and there's called the variable rate. Okay, so this is where we're getting into our stuff, right? I think we're good. All right, so we have what's called the fixed rate and the variable rate. Okay, so then what happens here? Okay, with the fixed rate, variable rate, what's the difference? What's the so what's the difference between a fixed rate and a variable rate? Okay, While the fixed rate, you get the uh, same interest rate is paid for the life of the loan. Okay, so fixed rate for the life of the loan. So here, so we have the fixed rate again. So there are two types of interest rates. There's what's called the fixed rate or the variable rate. All right. So the fixed rate is when, with the same interest rate is paid for the life. So if you have like a 3.5 interest rate, then it's going to be the same throughout the whole life of the loan, which is 30 years, 20 years, 15 years. Okay. The variable rate is that it could go up or down, so it's not guaranteed. It might go up, it might go down, so it's gonna be different. All right, you never know, depending on the market. I don't know. I don't know too much about like the market and why it does that. Is like, all right. So that's it. So make sure. So an interest rate in simple terms, just simple terms, it's basically the the extra money, all right? Because you're paying back the loan, what you bought, but it's just that extra money you pay them. The extra money paid to the lender for what? Why do you think the extra money paid to the lender for what? For lending you the money, all right? Okay, so that's basically it. They're lending you the money, okay? To what? To pay off the to pay to pay off the what is it? To pay off the house um, to the seller. Okay, there you go. So go ahead and write that down real quick. So basically, in simple terms, I just try to put it in simple terms. So again, what is the interest rate? It's the extra money paid to the lender for lending you the money to pay off the house to the seller, right? And my question was, you know, on top of that, and if you got a FHA loan where you're putting 3.5% down, not only are you paying interest, right, whatever the interest is, but you're also paying the mortgage extra. Do you pay PMI over here on conventional loan? No, you don't pay PMI, right? So you're saving that $300. Why? Because you paid a good amount, a good percentage, all right, up to 20%. So what is your monthly house payment called? Does anybody know? It's called the mortgage payment, all right? It's called the mortgage payment, all right? Hey, do you have a mortgage payment? That means that you're actually buying a house, all right? Hey, do you have a rent? What's your rent? So that's totally different. Two different things. So your monthly house payment, all right, not your rent payment, your house payment is called the mortgage payment, all right. And what does that cover? Okay, and there's a lot of things it covers, and we're gonna talk about that. Okay, so what does I'm gonna pause it here. Okay, so I'm not. plus your interest. Okay? Your principal plus your interest. All right? And then there's another thing that it pays off. Okay? So I kind of wanted to stop here. There's more notes, but I think I did too much with the other class because I wanted to get into with something else. And I will do that on Thursday. I will continue here. Okay?
That's right, Peter.
Huh?
That's right, even as a little chance.
Yeah. So again, what does your mortgage payment pay? Emerson, what does it pay?
Principals and interest.
And what's principal?
Like the principal on your balance?
Yeah, your balance. Like how much you owe. That's what it's paying.
Okay.
All right?
How much you
Here. Side note. So this is the last part, and then we won't do the other part. Okay? So here, the mortgage payment. No. Mortgage payment pays off oh hold on, let me pause it. In the beginning years, when you make your payment, most of the money that you pay, do you think it goes 50-50? So let's say you pay $100 a month, right? Okay, 50 is going to go to principal and 50 goes to interest. Do you think they're going to do that? No, no, no. And you'll see that it doesn't work that way. Most of it is going to go into interest. All right. That's why I put in beginning years, mortgage payment pays interest more than the principal, more than the principal. Okay. Why do you think they do that? I'll pause. So if you have a fixed a payment, this is month number one. You see the how much the interest is? How much is going to your house, to your balance? Only $32. See that? How about in 180 months? 180 months is like what? 12 years? Now the interest is a little lower, but and more of the principal, right? You see that? And then after like 20 years, now your interest is $14, and now you're paying a lot more to the principal to your house. See that? But you're still paying the same amount. So why do you think they're doing that? Because they want to make money. You know, they want to make money at the get-go. All right. So that's basically it.